Something extraordinary is about to happen. Not next year, not someday, now. As the calendar flips and the new trading year begins, the financial system is walking directly into a silver shock it cannot avoid, cannot hedge, and cannot delay. And almost no one is prepared for it. This is not a theory. This is not hype. This is a collision. A collision between institutional mandates, empty vaults, geopolitical hoarding, and a macro system already cracking under its own weight. And once this collision happens, price will not negotiate. Let's start with the moment everything changes. January 1st. For retail investors, January feels symbolic. For institutions, it's mechanical, unforgiving, automatic. On January 1st, the largest pools of capital on earth are forced to rebalance. Pension funds, insurance companies, endowments, sovereign mandates, they don't speculate. They don't wait and see. They follow models. Those models reset at the start of the year. After a volatile 2025, characterized by currency debasement, bond instability, and geopolitical stress, those models are flashing something almost no one expected. Silver, not as a trade, not as a hedge, but as the top performing asset, allocation under forward risk projections. This matters more than any headline, because these institutions don't ask if they want to buy. They ask how fast they must. Estimates vary, but conservatively, over $50 billion in institutional capital is mandated to move into silver exposure at the start of the year, not over months, immediately. And here's the problem. There's nothing for them to buy. The physical market is already tapped out, dealers are sold out, premiums are exploding, mints are delaying deliveries, miners are withholding production, waiting for higher prices. This is not anecdotal. This is systemic. When the largest, least emotional buyers on earth are forced to buy, and supply is already gone, price doesn't rise gradually, it gaps. And this is where the paper market narrative completely collapses. Because while futures prices hover in the low 70s, the real market is screaming scarcity. Industrial buyers aren't looking at charts, they're looking at production schedules. Solar manufacturers need silver for panels. EV producers need it for power electronics. Grid infrastructure needs it for conductivity. And these buyers are already paying $80 an ounce in private deals just to lock in 2026 supply. Not because they want to, because they must. This is the definition of inelastic demand. Now add the behavior of the banks. At the end of every year, banks de-risk. They sell. They clean balance sheets. They suppress prices. That's exactly what we saw as silver was pushed down towards $70. It was an IT bearish sentiment. It was accounting. But now the calendar has flipped. And those same banks know something crucial. Their clients are coming back with orders they must fill. So what do banks do in this situation? They front run, they buy first, cheap, aggressively, so they can sell higher once institutional flows arrive. This isn't speculation. This is how the system works. And that means the banks that helped push silver down are about to become some of its most aggressive buyers. At the same time, China is draining the West. Silver is quietly flowing east at a premium, not through futures, through physical shipment. China is buying Western silver, paying above spot, locking it away, and implementing export controls that restrict how much ever comes back. This creates something terrifying for the paper market, a one-way flow. Once metal leaves Western vaults, it doesn't return, and this arbitrage doesn't just tighten supply, it creates a price floor. Because if silver dips too far, China buys more. If it rises, they already own it. Now add the macro backdrop. The US debt ceiling fight is approaching. Bond markets are already unstable. Inflation is sticky. Real yields are negative. The Federal Reserve is trapped. Print to stabilize debt, weaken the dollar. Tighten to defend the dollar, collapse markets. There is no clean path forward. And in moments like this, commodities stop being commodities. They become money. Silver is not being treated like an industrial input anymore. It's being treated like an exit, a currency lifeboat. And here's the crucial distinction most people miss. This move is not being driven by retail mania. Retail comes last. This move is being driven by mandated institutional buying, industrial survival demand, geopolitical stockpiling, currency debasement. Those forces do not reverse easily. They don't get scared by pullbacks. They don't sell because of headlines. They buy because they have no alternative. This is why $75 matters. It's not just a number, it's confirmation. Above $75, momentum funds trigger. Risk models flip, capital accelerates. Above 83s, the previous high, the market enters open air. No resistance, no historical memory. And that's when psychology shifts from, is this real, to how high does this go? But make no mistake, this will not be smooth. There will be violent pullbacks, engineered volatility, attempts to shake weak hands, because leverage will explode, and leverage always gets punished. This is why the message matters. Not leverage, not emotion, not FOMO, discipline, physical ownership, and a plan. because this is not about selling for dollars. Dollars are the problem. The real strategy is ratio-based. When silver compresses the gold to silver ratio, that's when wealth is transferred. At 31, you start thinking. At 21, you prepare. At 15-1, history says the cycle is complete. That's not hype. That's 2,000 years of monetary precedent. And we are moving in that direction faster than most people can comprehend. This isn't the start of the storm. This is the eye-opening. And when the full force hits, the move will not ask for permission. This is the moment where preparation matters more than prediction. Because when supply is gone, and mandates are active, and trust is breaking, the market doesn't wait. Here's what happens next. And this is the part most people are not psychologically prepared for. Once silver clears its prior highs, the market stops behaving like a market and starts behaving like a rationing mechanism. In normal conditions, price discovery balances buyers and sellers. In shortage conditions, price exists for only one reason: to decide who gets the remaining supply, and we are entering that phase fast. Because once institutional buying collides with physical scarcity, there is no incremental adjustment. There is only escalation. The futures market can print contracts. It can create paper liquidity. It can delay, but it cannot create silver. This is where the disconnect becomes fatal. Right now, the paper market still pretends supply exists. The physical market knows better. That's why premiums are exploding. That's why delivery delays are becoming normalized. That's why miners are holding back production. Because everyone who touches real metal understands something critical. This is not a cyclical shortage. It's structural. Silver has been in a supply deficit for years, not months, not quarters, years. Every year the world consumes more silver than it mines. That gap has been filled by above-ground inventories, and those inventories are now depleted. This is why higher prices don't solve the problem. Silver is mostly a byproduct metal. It comes out of copper, zinc, and gold mining. You don't just turn on silver production. Even at $100 an ounce, new supply won't arrive in time, which means price has only one job left: destroy demand. But here's the paradox. The largest sources of demand can't be destroyed. Solar doesn't stop. EVs don't stop. Grid upgrades don't stop. Defense doesn't stop. These sectors are price insensitive. They will pay whatever is required, because the alternative is shutting down production. This is why the market is so dangerous right now, because the traditional pressure valve doesn't work. And this is when volatility turns violent. You'll see days where silver moves $5, $7, $10, not because of speculation, but because someone couldn't get metal. And when that happens, narratives break. Mainstream commentary will say it's a bubble. They said that about oil. They said that about gas. They said that about food. But bubbles don't come from deficits. They come from excess. This market has the opposite problem. And here's where psychology flips. Right now, many people still think, I'll buy the dip. I'll wait for confirmation. I'll see what the Fed does. But once silver trades decisively above its prior highs, those options vanish because dips disappear. When everyone who needs silver realizes that waiting costs more than buying, price stops pulling back. This is how parabolic phases begin. Not with euphoria, with desperation. And parabolic phases are deceptive. They feel unstoppable until they aren't. That's why discipline matters. This is not about chasing. It's about positioning before the crowd realizes the rules changed. Because once the crowd arrives, volatility becomes extreme. And leverage becomes lethal. This is why physical ownership matters. Not because it goes up every day, but because it removes counterparty risk. Paper instruments rely on settlement, on liquidity, on trust. And trust is the first thing that evaporates in shortages. Now zoom out. Because this isn't just about silver. This is about the monetary system revealing its weakness. A system built on debt, on leverage, on promises. When confidence is high, it functions. When confidence breaks, it cannibalizes itself. And silver sits at the intersection of that failure. It's industrial, it's monetary, it's scarce, it's essential. That combination is rare and dangerous. This is why governments are paying attention, why critical minerals lists are expanding, why export controls are tightening. Because silver is no longer viewed as just a commodity. It's a strategic asset, and strategic assets don't get cheaper. They get controlled. This is why availability matters more than price, because once restrictions begin, once supply is locked behind policy, you can't buy what isn't offered. History is very clear on this. Markets warn quietly. States act suddenly. And when that happens, the window closes without notice. This is why the message is simple. Not easy, but simple. Don't chase leverage. Don't trade noise. Don't confuse volatility with weakness. Understand what kind of market this is. This is not a trading environment. It's a transition. From abundance to scarcity, from paper confidence to physical constraint, from optionality to necessity. And those transitions are never polite. They are messy. They are volatile. They are emotional. But they are also where wealth transfers occur, quietly, relentlessly, from those who react to those who prepared. This is not about fear, it's about awareness. Because once the system reaches this stage, it doesn't reverse smoothly. It moves until something breaks. And when physical reality finally asserts itself, price stops being an opinion. It becomes a verdict. If this analysis helped you understand what's happening beneath the surface, like the video, share it, subscribe. Because this situation is evolving in real time, and when the market finally admits the truth, it won't wait for permission.